You've got money sitting in checking doing nothing, and this year you've opened your brokerage app maybe 40 times without buying a single thing. Same loop every time. The market's at an all-time high, which feels like the worst possible moment to buy, so you close the app. 3 weeks later, it's at a new all-time high, which somehow feels worse. Here's the part that should bother you. The boring, federally insured, nothing can go wrong cash sitting in your savings account is currently paying you more than Vanguard's own economists expect the entire American stock market to return per year over the next decade. The safe thing is outbidding the risky thing. That's your mattress outperforming your mortgage. My neighbor Trisha has been stuck in that exact loop for 2 years. $11,000, 41 opens of the app, 0 purchases, and every month she waits, the number she's waiting for gets further away, which is basically the whole joke the market is playing on her. So let me save you the 2 years. My name is Nick, and I spend an unreasonable amount of my life reading fun prospectuses so that you don't have to. If you've ever sat exactly where Trisha's sitting, money ready and finger frozen, hit subscribe and leave a like. Because today I'm giving you the actual tickers, the actual percentages, and the actual order I'd buy them in if I were starting from 0 this month. Before you touch a single ticker, you need 90 seconds of context, because what you should buy depends on what's true about the market you're buying into. The S&P 500 is around 7,700, up roughly 14% this year and about 20% over the last 12 months. Great, now you're uncomfortable half. The Shiller ratio, which compares what you pay to 10 years of smoothed out earnings, is north of 40. The long-run median since 1881 is about 16.5. In 144 years, it's been higher than the price you'd pay today during exactly 2 stretches, and one of them was the dot-com peak. Welcome to your entry point. But here's where honest people split from thumbnail people. The forward price to earnings ratio, which uses next year's expected earnings instead of the last decade's actual ones, is around 20.4. Its own 10-year median is about 19.9. So one gauge tells you you're buying the second most expensive market in recorded history. The other tells you it's a normal Tuesday. Both are calculated correctly by serious people with great confidence, which is less useful to you than it sounds. They disagree because analysts expect earnings to grow enormously, and the Shiller ratio doesn't care what analysts expect. It's the one number in finance with no imagination whatsoever. Trisha's neighbor Delia is 61 and has watched you have this exact argument twice before. Both times she'll tell you the people who sounded smartest about valuations ended up owning the least. Hold that thought. Then there's concentration, and this one isn't ambiguous. The 10 largest companies in the S&P 500 are now roughly 40% of the index. At the dot-com peak, about 27. So when you buy a total US market fund today, 40 cents of your every dollar lands in 10 companies, and you're making a concentrated bet on artificial intelligence whether you meant to or not. You didn't pick that. You inherited it, the way you inherit a group project. Those 10 produce about 34% of the index's earnings, 40% of your price, 34% of your profit. That 6-point gap is the whole bull versus bear argument in one number. Now, your instinct here is to ask which fund. It was Trisha's too. It's the wrong first question, and it's wrong by a margin of thousands of dollars. Before any ticker, there's an order of operations. It goes like this. 1. If your employer matches your contributions, contribute enough to capture every cent. A 50% match is an instant 50% return, day one, guaranteed before the market does anything at all. No fund on earth does that for you. And yet Vanguard's 2026 report covering nearly 5 million accounts found only about 51% of participants saving at or above their target. Half of American savers are leaving free money in the parking lot indefinitely. Trisha's coworker Reggie is one of them, and Reggie can quote you 3 cryptocurrency prices from memory. Of course he can. If you can't recite your own matched formula right now, that's your homework tonight, and it's worth more than everything else in this video combined. 2, if you're on a high deductible health plan, your health savings account, $400 solo, $8,750 for a family. It's the only account in the tax code that's deductible going in, tax-free while it grows, and tax-free coming out for medical costs. Triple tax-free. It reads less like a benefit you earned and more like a clerical error nobody's gotten around to fixing. 3. Your Roth IRA. 7,500 this year, up from 7,000, phasing out between 153 and 168,000 if you're single. 4. Back to your workplace plan, up to 24,500. 5. Taxable brokerage, unlimited, no rules, no permission slips. So Trisha's 11,000 doesn't get invested, it gets sorted. Match first, then Roth. That's a move you can make this week without knowing a thing about the market, because identical funds hand you wildly different lifetime outcomes based purely on which bucket you left them in. Okay, the tickers. This is what you clicked for, and I'm about to make it deeply anticlimactic. If I got one purchase, one decision, and then somebody took my phone away forever, I'd buy VT. Vanguard Total World Stock. 0.06% a year. Roughly the entire investable planet in one ticker, rebalanced without you, no opinions required. But you probably want more control, so here's the breakdown I'd build you. 60% US total market. VT or VU, both 3/100ths. VT gets you about 3,500 companies, VU gets you the big 500. If your money's already at Fidelity, Fixix runs 1.5. Somehow even cheaper. 20% international. VIXIS at 5/100ths for everything outside America, developed and emerging together. 20% bonds and cash. Bend at 3/100ths for the total bond market, or SCUV at 9, which behaves almost exactly like treasury bills with the ticker attached. That's it. That's your portfolio. 3 funds, a blended cost of about 4/100ths%, and you'd own roughly 11,000 companies across 40-something countries by dinner time. And sit on that fee number, because this is where most of the damage in retail investing happens, and it never makes a sound. Fidelity sells a fund family called Freedom and another called Freedom Index. Same target dates, nearly identical glide paths, functionally the same product for you. The index versions charge you about 12/100ths%. The active versions charge you between 47 and 77. Same company, same shelf, one extra word in the name. Congratulations if you happen to pick the longer one, condolences if you didn't. Because you're paying 5 to 6 times the fee for the same retirement. Run $500 a month for 30 years at 7%. At 3/100ths%, you end up around $566,000. At 1%, you're roughly $90,000 to $100,000 lighter. That's a used car every 5 years of your retirement, handed to a fund company for doing exactly what the cheap one did. And you'll never feel it leave, because it doesn't leave the way a bill leaves, it leaves the way water leaves a glass you aren't looking at. Reggie has paid about 8/100ths for 4 years and has never once looked, because the fee never appears as a line item. It's not a charge, it's a subtraction. And subtractions don't send you a notification. So go find your own expense ratios tonight. 4 minutes, and it's the best paid 4 minutes of your year. Now that 20% going overseas is the single most argued about slice in the whole thing, so let's have the argument. Welcome to the comments section of every finance video ever made. The case against it is easy and emotionally satisfying. American stocks have crushed international stocks for 15 straight years, so why would you own the losers? And every year that gap widens, your argument gets more persuasive right up until it isn't. The case for it is arithmetic. Your US forward price to earnings of roughly 20 sits well above what international markets trade for, and the run of American outperformance you just lived through is one of the largest on record. Vanguard's own model currently ranks non-US developed equities above US equities for the next decade. But the real argument isn't a forecast, it's a receipt. From 2000 to 2009, the S&P 500 returned roughly 0%. 10 years. Nothing negative after inflation. Had that been your decade, you'd have done everything right and been paid nothing for it. And Japan's Nikkei peaked in December of 1989 and didn't durably reclaim that level until around 2024. 34 years underwater in what was then the most advanced, best educated, highest savings rate economy on Earth. Nobody in Tokyo in 1989 thought they were living through a cautionary tale. They thought what you think right now, which is that they were living through an obvious truth. Delia still has one of those American business magazines in a box somewhere. The kind with a cover explaining that Japan had simply figured out capitalism better than everyone else. She keeps it as a humility device. So your 20% international isn't a prediction that America loses, it's a 20% premium you pay on never needing to be right. Which brings us to your bonds, and you need to hear this. Because bonds have been a punchline for 15 years and the punchline has expired, for most of that stretch, a total bond fund paid you 1, maybe 2%. You held it as ballast and you quietly resented it. Reggie still talks about bonds like they're something your grandmother owns alongside a landline and strong opinions about envelopes. That was a reasonable position for you in 2019. It's an expensive one now. Today, Ben pays you somewhere in the 4 to 4.5% range. 2-year treasuries pay you around 4.2, 10 years around 4.6, and Vanguard's 10-year model puts your high-quality U.S. fixed income at roughly 4%, which sits inside and possibly above. The band it projects for your American stocks. Let that land. One of the largest asset managers on Earth is telling you the boring thing may pay you roughly what the exciting thing pays, without any of the excitement and without the part where you check your phone during a funeral. There's also the I bond, which nobody mentions anymore because it stopped being a meme. Around 4.25% composite on a fixed portion of 9/10, so you lock in a guaranteed return above inflation for as long as you hold it. You're capped at $10,000 a year, and it resets the 1st of November. One honest caveat, because I won't sell you a clean story. The 30-year Treasury recently touched a 19-year high above 5.3%. And inflation is still running 3.4 headline above the Fed's target, so own intermediate bonds and Treasury bills, not 30-year paper. You want to get paid for waiting, you don't want to get paid for guessing. Now, the sleeves. This is the part Trisha wanted to talk about first, and the part that matters least, which is true of roughly everything fun. Want a small cap value tilt? Avuv 25 100ths. Want dividends? 6 100ths, paying you 3 to 3.5, both defensible, neither necessary. Skip them both and you've given up almost nothing. Gold if you want it, IOM or Gledam at 9 to 10 100ths, not Gled at 40. Same metal, same vaults, 4 times the price for the privilege. And Bitcoin. IBIT or FBTC, both 0.25%. Reggie owns considerably more than 0.25%, and he'd like you to know he's early. Here's my honest position for you. Cap it at 5% of what you own and size it like it could go to 0 tomorrow. Because in 2025, while gold rose something like 66%, Bitcoin fell about 6%. And in 2026 so far, it's the worst performing major asset class you could have picked. The digital gold thesis got a live fire test against actual gold. Actual gold won. That doesn't make it worthless, it makes it a speculation, and your speculations belong at the edge of your plate, not in the middle where the food goes. But here's the thing. Everything I've just handed you, every basis point, every percentage, every ticker, matters less to your outcome than the next 4 minutes of this video, which is not what you want to hear after 11 minutes of tickers, because the biggest threat to your returns isn't valuation, it isn't concentration, it isn't the Fed, it's you. And I say that with total affection, because it's me too, and it was Delia once, and of course, nobody has ever built a product to protect you from that. Morningstar tracks something called the investor return gap. Over the 10 years through 2024, the average fund returned about 8.2% a year. The average dollar you'd have had in those same funds earned about 7. Same funds, same decade, 1.2 percentage points a year evaporating purely from when you buy and when you sell. roughly 15% of your available return gone, not to fees. To your timing. And I'll be straight with you, there's an academic argument that a chunk of that gap is just the mechanics of monthly contributions rather than panic, and your true penalty is smaller. Fine, even at the low end, the error points the same direction every time. Reggie is that gap in human form. 11 positions in 3 years. And he isn't unusual. Your average American holding period for a stock is now roughly 5.5 months. In the 1950s, about 8 years. We went from owning businesses to renting tickers. And you get nudged further that way every time you open an app that congratulates you for doing something. Reggie isn't stupid either, he's doing precisely what the app was built to make him do, which is act. It has never once suggested he close it and go outside. So here's the number that should end your argument. JP. Morgan looked at the 20 years ending in 2023. Your $10,000 fully invested in the S&P 500 the whole time becomes about $64,800. Miss only the 10 best days out of roughly 5,000, and you end with about $32,500. Half your money. 10 days. And here's your trap. 7 of those 10 best days happened within 2 weeks of the 10 worst days. The best days live inside the worst weeks. They aren't separable. So every plan that says you'll get out when it gets scary and buy back in once things calm down is mechanically a plan to hold cash on precisely the days that pay you. You don't get your recovery without sitting through the part that made you want to leave. Which is Trisha's real problem, and it was never picking the wrong fund. It was never owning one, and paying a professional doesn't fix this for you either. In 2025, 79% of actively managed US large cap funds lost to the S&P 500. Over 15 years, your odds of picking a winner sit near 1 in 10. These are people with Bloomberg terminals, research teams, and every financial incentive on earth to beat the thing you can buy for 0.03%. They lose to it. Good luck picking your winner in advance. Now, you're sitting there thinking, sure, Nick, but this is obviously a terrible time for me specifically to start. So let's go back to Delia. She bought in October of 2007, not near the top. The top. The literal peak within days. Then she watched the S&P 500 fall 57% over 17 months, while every anchor in America explained the financial system was ending. She didn't sell, mostly, she'll admit, because she couldn't bear to look. Her statements went into the same kitchen drawer as the takeout menus, unopened, for about 3 years. She was whole again around 2013, and her money has multiplied several times since. The worst timed lump sum in modern financial history still worked, on exactly one condition. She stayed. That's the only variable you actually control. And if you're young, a crash isn't your enemy anyway. It's your discount. If you're 31 like Trisha and buying every month, a drop means every purchase you make for 2 years gets you more shares at lower prices. A bad decade early is a gift you won't recognize for 20 years. Nobody tells you that, of course, because nobody sells anything with it. In February of 2020, the market fell 34% in 33 days and hit a new all-time high by August. Everyone who bought in that window looks like a genius to you now. They did not feel like geniuses, they felt sick. There's an old line that Fidelity found its best performing accounts belonged to people who died. I've never located that study, and Fidelity has never published it, so it's almost certainly folklore. But it spread because the idea underneath it is measurably true. And it applies to your account. Your inactivity beats your activity. The dead are simply exceptional at not touching things. And I want to name what paralysis actually costs you, because it never shows up as a loss on any statement. It's opening the app on a Sunday night, looking at the number, and closing it without doing anything. Again. It's telling yourself you'll start once things settle down, then watching things refuse to settle down for 2 straight years. It's the friend who brings up the one trade that worked at every dinner, and the specific quiet that lands on you afterward. It's doing the math on what your money would have become if you'd bought in March, and then deciding never to do that math again. Nobody sends you a statement for any of that. There's no line item that reads money you didn't make because you were being careful. Your loss is invisible, which is exactly why it's allowed to keep happening. Trisha's account never went down over those 2 years. It just quietly stopped being the size it could have been. And if you're watching this feeling behind, sit with one number. Vanguard puts the average 401k balance around $168,000. Your median is $44,000. A four-fold gap, because a small number of enormous accounts drag that average into a shape that has nothing to do with your life. The Fed's numbers say the same. Mean 334,000. Median 87. So every time an average makes you feel behind, understand what's being done to you. You're being measured against a distribution bent upward by people who aren't in your situation, your tax bracket, or in a lot of cases, on your continent. You're not behind. You're being compared to the wrong number. And you're not bad at this. You were handed a market at record highs, an app engineered to reward you for touching it, and roughly 900 people online explaining that the crash starts next month. Freezing was a completely reasonable response to all of that. It was just an expensive one, and you were never told the price. If pulling numbers apart like this is your thing. I run a school community where I walk you through it alongside people building channels from scratch. Links below. No pitch, no upsell. Obligatory and sincere, I'm not a financial advisor, and this isn't financial advice. It's public numbers and how I'd read them. Your situation has variables I can't see, and every figure I've quoted has a shelf life. Yields move, valuations move, the Fed moves. Check them before you act. So here's where Trisha lands. Match first, Roth second. 60, 20, 20, Vitae, Vixis, Bend. She automates the transfer for the day after payday, so the decision gets made once instead of relitigated every month by a woman at 11 at night with a phone in her hand. Then comes the hard part, the part you don't get to outsource. She does nothing for 30 years, in a world engineered at every level to make your doing nothing feel irresponsible. Reggie will beat her some years. You'll hear the story at Thanksgiving, the one about the position that tripled. You will not hear about the 7 that didn't, because nobody does ever. And I don't blame him for any of it, and neither should you. He's playing a game designed very deliberately to be more fun than the one that works. Delia will beat both of them. Her entire strategy was a kitchen drawer full of unopened envelopes during the worst market in 80 years. That's the whole thing. Not a secret ticker. Not a signal. 3 funds, 4/100%. And the deeply unglamorous discipline of staying boring on purpose for longer than feels reasonable to you. Welcome to the least impressive strategy that works. The market doesn't pay you for being clever, it pays you for being present. So the only real question left isn't what you should buy in August of 2026, it's whether you'll still own it in August of 2056.